The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho, and these are your headlines. So we have futures pointing to a positive open in Europe, but UK inflation hitting the wires, and it is yet more good news for the government as a November CPI year on year up 3.2% versus a poll expecting 3.5%. The November services CPI down 0.2% on the month. That is beating expectations for unchanged. And if the economists are listening, the RPI 3.8% year on year, that is way better than the 4.2 expected. So that is the UK inflation print hitting the wires.
CNBC learns that OpenAI is in talks with Amazon about a potential investment that could top $10 billion after Sam Altman negotiates with Microsoft to allow the group to expand its partnerships across the tech space. Crude prices move higher after President Trump brands Venezuela's government a foreign terrorist organization and orders a blockade on sanctioned oil tankers moving in and out of the country, a move the Maduro government says violates international law.
Okay, so we've just broken you the figures, and I'll just reiterate it. This is a way better figure for the government, for those doves out there at the headline level. I know there's a lot of nuances below the surface, but much better than many had feared. The November CPI headline figure year on year is 3.2%. The Reuters poll was for 3.5%. The month-on-month figure, negative 0.2% month-on-month. The Reuters poll was 0% as well. RPI, and if Paul Donovan's listening, I know he's a massive fan of RPI, up 3.8% year on year. I know he's not. Poll was for 4.2. Why don't I just get a quick word from Karen on this one before we get to our expert in the wings?
Well, setting the scene before the Bank of England, right? Having that headline inflation come lower, clearly not around the target price still, or target level that the market's been looking for over the long term, but we are coming back in the right direction. So central bank targets matter at some point.
All right, let's get to Paul Donovan. Paul, just drag yourself away from the RPI figure and concentrate on CPI if you could, just for one moment, my friend. Sorry, people have got to watch for years to have known that joke. Paul Donovan, Chief Economist at UBS Global Wealth Management. How are you, sir? What do you think of the data?
Well, it's a positive trend, of course. The markets have been expecting UK CPI to be coming down over the course of the next couple of years. We're going to be seeing further downward pressure next year because of the very weird way we do energy pricing. There's going to be some downside as the government's taken measures to reduce some energy prices, electricity prices for some people. Some technical changes around the way food prices are calculated to improve the accuracy of food price measurement. They kick in next year. That's also going to help. But generally, the underlying trend here is for more moderate inflation over time. A lot of the stickiness of UK inflation has really been about sort of government controlled prices, administered prices like the electricity price cap, which have created an upwards pressure, whereas actually beneath the surface, things haven't necessarily been quite so inflationary.
Paul, I had the temerity of speaking to another economist off camera today already. I know, it's terrible. You can't have too many before 8 a.m. But he's very worried about the UK economy in the medium term. Sorry, I beg your pardon, the short term. He thinks actually he's going to downgrade his growth estimates very, very soon as well. He doesn't think the government growth measures are bearing fruit just yet. What are your thoughts?
Well, again, the UK economy was the fastest growing G7 country in the first half of this year. Momentum has slowed a little bit from that sort of very strong growth that was coming through on a comparative basis earlier this year. There is a moderation of economic activity. The immigration numbers are down. That leads to a somewhat slower pace of growth in the near term. On the other hand, the labour market is doing okay in the UK. You've got earnings growth, which is still fairly okay, particularly in real terms with these inflation numbers. And of course, the UK household balance sheet, the savings versus debt, is in a very good position. So I wouldn't be rushing to be too pessimistic about the UK. I think you operate more or less around trend next year, in spite of the government's moves towards some fiscal tightening.
Paul, good morning. It's Karen jumping in. The point I was alluding to in the open was that it's taking a long time to get back to a 2% inflation target that the Bank of England has been targeting. In fact, the forecasts were for right at the end of 2027, we might eventually become within touching distance of 2%. Now that we see a steeper fall in the inflation rate today, do you think it has any bearing on getting back to that 2% target?
Well, again, it's going to depend in large part on what happens with some of the technical prices, the fictitious owner's equivalent rent, the government-controlled or government strongly influenced electricity pricing, things like that will have an impact there. The underlying inflation pressure, you look at things like the British Retail Consortium shop price index, you're not seeing the same sort of inflation story there. It's more benign overall. So I think that we will see the moderation coming in. Whether this actually affects the Bank of England is a slightly different question. I think the bank is on course to cut this week and will probably cut a couple of times next year. But the MPC, of course, is just riven with disagreement. He's always riven with disagreement. But there's particularly strong factions at the moment disagreeing over how they should be responding to this moderating inflation environment.
Let me pick up on that Bank of England comment and what the pathway will look like in terms of rate reductions from here versus the US Federal Reserve. How do you see that playbook between the two central banks balanced across 2026?
So I think the Federal Reserve is obviously in a different position because the Fed is looking at rising inflation going into the first quarter of next year. And there's a lot of uncertainty about how sticky some of the inflation pressures arising from the tariffs might actually end up being. This all depends on what happens to the legality of the tariffs, whether there's sort of an additional fiscal boost if tariffs are declared to be illegal, and then there are rebates paid back to the American companies that paid the tariffs in the first place. It all gets very messy for the Fed. I think what the Fed is trying to do is not so much stimulate the economy as put in place insurance to prevent rising fear of unemployment concerns building on the labour force side. Whereas the Bank of England perhaps is saying, well, we're running a more restrictive monetary policy and we need to be moving back to neutral. So it's a subtly different set of pressures that are driving the two central banks, and that will allow for some divergence in terms of the policy.
Paul, I'm interested to know what you think about the labour market in the United Kingdom as well. I anecdotally and professionally speak to a lot of people as well, and every off-the-record conversation I've had with a potential hirer has raised two issues. One, we are terrified at hiring people at the moment because we are concerned about change of labour laws and increased costs. Two, actually a lot of the great talent we want doesn't want to work in the UK at the moment because of those onerous tax laws and are looking tax rules and regulations are looking elsewhere. Are you concerned about the UK labour market?
Not particularly, no. And, in answer to both of those points, I mean, they would say that, wouldn't they? Companies don't like tax. That's just a basic fact. And they'll complain at every opportunity that they get, particularly if it's a high-profile television host at a drinks party. So you're obviously going to be getting that sort of anecdote coming through. If you look at it, the median taxpayer in the UK, that is to say the typical taxpayer, has one of the lowest tax rates in the developed world, far lower than the US, than nearly every country in Europe. And that is something which is actually a bit of a challenge for the UK government, because when we're looking at fiscal shortfalls, that's where some of the problems come in. We had all this whinging coming out of the retail sector, for example, at the end of last year with minimum wages and national insurance, and we can't afford this and we can't afford this. And yet, you know what? They're still making very, very large profits and they're still employing more people. So I don't really think that we're actually seeing significant concerns emerging on the labour market in the UK. The labour market remains relatively strong overall.
Swipe at economists, swipe at TV anchors. I think you're both even now as we take track of this, Paul. But let me ask you about the gilt market and whether we're out of the woods from here. We're not at the highs, we're not at the lows when it comes to that 10-year gilt. Do you think that the Chancellor has managed to land the budget okay, given the data and some of the challenges still for the UK economy?
Yes, I think the UK's fiscal position is generally, stronger than many countries in Europe. There has, of course, been a risk premium, that's the polite way of putting it, ever since the Truss debacle, because that did sort of shake confidence in the UK government as an institution. That risk premium, I think, has been chipped away at and continues to be chipped away at, and we are seeing gilt yields moderating more or less at the moment. And I think in an environment where we are going to be seeing US rate cuts, certainly there's going to be a lot of pressure to keep the long end of the yield curve down in the US. where the Treasury has been shuffling the debt issuance here in the UK to focus more on shorter duration, then I think we will end up with a further reduction in that risk premium coming through in the UK.
Paul, I know you're going to stay with us for a good channel in the US, but I do have a bone to pick with you. High-powered news anchor at drinks parties. I tend to do lunch nowadays rather than drinks parties. I find them much more amenable. Anyway, just a small point of detail. You'll stay with us for the US chat.
Yeah, that drinks party doesn't really work for ours,
No.
does it? And let's take a look at those US markets stateside. A lot of data filtering through, and of course, this is the first batch this week as we take a look at the reports on the back of the government shutdown. So we had the jobs report for November, payrolls increasing. We'll get into the weeds, 64,000 on the back of those October numbers where we saw the government cuts. The market wondering whether we've got distortions in the figures, whether they're looking at true data as we roll across to some of the inflation numbers later to this week. But for the Dow and the S&P 500, that reading on the economy was a weaker tone, and you can see as a result both of those areas flipping lower in the session yesterday. The tech sector, though, the Nasdaq support, and you can see marching higher. In terms of some of the improves, Tesla, one of the movers to the upside yesterday. The momentum we've seen in that name continuing in session. The movers to the downside, the likes of Goldman Sachs and Alphabet, undermining the direction for the Dow and the S&P. To the European futures early on this morning, we are setting up for a day that looks mildly positive on the back of a weaker session yesterday. We were down almost 0.5% on the Stocks Europe 600 as we closed up shop yesterday. Second negative session out of 3. So we're looking to change the tone as we get set for the session this morning. Well, US futures on the back of that mixed bag yesterday for the US markets. You can see looking a little bit flat on the Dow still, but slightly higher, inclined to move into positive territory at the start this morning at this early hour, Steve.
Right, so delayed US non-farm payroll data showed the US economy added 64,000 jobs in November, beating the expectations of 45,000 increase. However, it wasn't all good news, with the unemployment rate rising to 4.6%, the highest level since September 2021. The November reading came after non-farm payrolls fell by 105,000 in October amid a steep fall in government employment. Well, the search for the next Fed chair continues, with the US President Donald Trump reportedly set to interview Governor Christopher Waller today. This according to the Wall Street Journal. Waller is one of several candidates under consideration, in fact the only one not called Kevin, as the president searches for a replacement to the current chair, Jerome Powell, who, just remember everybody, who appointed Powell? Yes, it was Mr. Trump. Speaking to our US colleagues, another Fed chair finalist, NEC director, who is called Kevin Hassett, stressed the importance of data in deciding interest rate moves.
The Federal Reserve's independence is really, really important, and the voices of the other people at the FOMC, they're important too. And so the way you've got to drive interest rate movements is with consensus based on the facts and the data. And I would say that's something that has been not really working so well for the Fed over the last few years. Like, what are the facts? So when they made a mistake on this or that, then why did they make that mistake? What model got it wrong? That's the kind of stuff that becomes convincing over time, because you actually have a track record of getting things right, and when you get things wrong, you explain why and fix it.
There are 12 voting members. Paul Donovan, chief economist at UBS Wealth Management. 12 voting members, 19 in total as well. Are we making a storm in a teacup about the appointment of the chair, Paul?
So that's a difficult question, because traditionally the Fed chair sort of does rule the roost. That the last time a Fed chair was outvoted was back in the 1980s, when Paul Volcker was outvoted, and he immediately resigned as soon as he was outvoted by the FOMC on his choice of policy. So the chair has tended to dominate in a way that perhaps the Bank of England governor doesn't, where forcing the Bank of England governor into a minority is almost a sporting event as far as the Bank of England's Monetary Policy Committee is concerned. It's something they like to do every once in a while just to keep them humble. So the Fed chair has traditionally had this very, very dominant role. However, over the course of the latter stages of Powell's tenure, we have started to see more dissent. I mean, there's almost a British accent creeping into some of the Fed deliberations, that we have had three-way dissents. This is not normal at the Fed. And so I think perhaps the power of the Fed chair may be diminished. It's still going to be very significant, but I think it is being diminished. And if the wrong person is put in place, then I think it is perfectly possible that the FOMC will just ignore them entirely, and you'd actually get a break with that precedent that you follow the lead of the Fed chair.
Paul, I'm not sure the worth of the dot plot, but it's actually fascinating reading, trying to work out who does what. But it's not so difficult to work out who the chap is who wants 150 basis points. His name's not Kevin, but it might as well be. But bearing in mind that he thinks that the US economy needs 150 basis points worth of rate cuts, that's the aforementioned Mr. Myron, by the way. Do you think he's right or the rest are right, or how does it fit for you?
So I struggle to get to the idea of 150 basis points of rate cuts. I think the issue that you've got in the States is that we know there is going to be further upwards pressure on inflation coming through as the August tariffs filter their way through into the system and work their way down supply chains to the shelves of supermarkets and other retailers. So we know that inflation is not peaked yet. It's probably going to be peaking late first quarter, early second quarter of next year, something like that. So the question for the Fed is, do you want to be trying to stimulate the parts of the economy that are not being affected by tariffs and potentially adding price pressures in the other areas of the economy, like the service sector? And I don't think the Fed wants that. Now, what it doesn't want is fear of unemployment creeping in, because that would be a very negative thing for consumer spending. What has happened so far is that since April, the price increases that have taken place in the US economy have almost dollar for dollar been matched by US consumers cutting back on their savings. So if something happens to give consumers a sense of fear about the future, they stop cutting back on their savings, they stop spending money, that would become a very negative thing. So the Fed's got this delicate tightrope to be walking between these issues.
And the retail is telling us that a lot of the consumers are buying smaller items too, so much shrinkflation in their own basket. Let me ask you from peak to trough, because there was some reports yesterday, T. Rowe Price was saying that they think the labour market may have troughed over summer, which was interesting given we saw the unemployment rate mark up to 4.6%, a level that an economist told us yesterday could be the high watermark in this cycle. Do you think 4.6% is as toppy as it gets on the unemployment rate, or do you think the Fed's got a problem from here?
So I think you might see some further increases in the unemployment rate simply because what we saw in the last data release, and bear in mind, I mean, the quality of this is dubious, to put it mildly. But given the data that we're working with, you were seeing people come into the workforce, re-entering the workforce, and that's a signal perhaps that the cost of living, affordability, call it what you want, is starting to do some damage to consumer spending power, and perhaps people who had taken themselves out of the workforce are saying, well, actually, maybe I need to go back and try and find a job, or maybe we need to supplement the household income in some way. So you're seeing some of that go on. Now, if that happens and those people don't get a job, then obviously you end up with a higher unemployment rate in the household survey. And that would be something that we might be seeing continue into the future if people feel that they need to bolster household income a bit more. That could give you some upside on the unemployment rate, potentially even from these levels.
So, Paul, as I listen to your commentary, it doesn't feel as though the Fed has shifted its narrative from the inflation mandate to the employment mandate. It feels as though it's still got a challenge on both sides. Is that how you describe it?
Yes, I think it is. And obviously, if you look at the Fed and the comments that are coming out of the various members of the FOMC, you've got people in both camps. So you've got people who have clearly put their focus on the labor force, and then you've got people who are saying, no, it's all about inflation, and we mustn't allow inflation to become sticky and become an enduring problem. So you've got these two forces together. I think if you look at people sort of more around the middle, people like Williams, the New York Fed president, what they're saying is, look, we recognize that the labor market has some risks. We recognize that the pace of job creation has slowed this year compared to the previous 4 years, quite notably. Things like manufacturing employment continue to trend downwards. So they're very cognizant of all of that. And they're just wanting to put in place some security on that without going as far as stimulating the economy and potentially lighting a fire under the inflation pressures.
Paul, I'm worried about the bottom leg of the K. Maybe I shouldn't be worried about it, but if you can find evidence aplenty about student loans, revolving credit, home loans, what have you. There is an uptick in delinquencies. Maybe I'm looking for data and finding it where I want to see it as well. But when I add that to the fact that Americans are beginning to be very concerned about the president's handling of the economy, and his approval ratings are just slipping a bit yet again. Do you think that actually the median earner, the low earner in the United States is beginning to really suffer and there are problems there?
So the median earner, no. The lower income groups, yes, perhaps are feeling things a little bit more difficult these days. The lower income groups tend to face a higher inflation rate than is reported because of what goes into their basket of goods. We have seen as you say, some issues around credit. The lower income households didn't have the strength of balance sheets that the sort of the median, the middle class households have had. So they don't have that cushion of savings to fall back on. So that group has been undoubtedly, I think, feeling things a little bit more severely. For the median earner, I don't think that is so much the case. Now, yes, you then have the reports of the very low poll ratings the president is getting for the handling of the economy. That's complicated, though, because, of course, the extraordinary vicious polarization of politics in the United States means getting an opinion that's actually genuine is very, very difficult. But also in economic terms, as President Biden experienced, consumers are not very good at judging things like inflation. They tend to focus on high frequency purchases rather than what they buy over the course of a year. So when you see things like the sharp increase in the price of beef or the price of coffee, that makes you feel bad. And who do you blame? Well, you blame whoever is sitting in the White House at that particular moment in time. So that's been, again, I think, part of this narrative. But at the end of the day, you don't spend that much on beef in a week. You don't spend that much on coffee in a week. Well, economists do, but otherwise you don't. And so you're not actually feeling things as bad as you think you are. And at the end of the week, you've still got money to spend. So that gives you sort of this perception reality breakdown that is also coming through.
Point of alignment between economists and journalists, I think, Paul, when it comes to coffee. Let me ask you, though, about the big AI driver that's been a trigger for economic growth, deep investments from cash-rich companies, debt also being rolled into building out this infrastructure. What sort of a tailwind does the US economy enjoy thanks to the AI story into 2026?
Well, AI is an interesting one because AI investment, you're quite right, it's contributed about half of the growth rate, not half the GDP, obviously, but half the growth rate of the US economy this year. But at the same time, it has also detracted because what we've had is AI sucking resources out of other areas of the economy. So the factory building boom that we've had in the last few years in the States has rolled over this year. But if you did want to build a factory, you'd find it more difficult to do that because everyone's building a data center down the road. You don't have the workers, you don't have the resources. So that's then become something of a challenge. And the issue here is that with a lot of the AI investment, the investment itself generates growth. But when you've built the data center, is the data center generating a great deal of economic activity? Not right now, no. The expectation is it will in the future, but you flip a switch, you turn the data center on, it's not necessarily generating.
Oh, we seem to have lost Paul there.
Did he just say flick a switch and someone just flicked the switch on him?
Exactly. I think the AI stepped in and
what a shame.
Shut down the signal. Oh. We didn't get a chance to.
We've got him back.
He's back. He flipped the switch again.
Yeah,
Paul, do you want to finish that, Paul?
So I was just saying that if you build an AI data center, turn it on, it doesn't immediately contribute to the economy. It may be several years before it does. You build a factory, turn it on, it contributes to the economy from day one. So if you have had AI taking resources away from factory building and so on, that does generate growth because you're building a data center. But then the next stage, you're missing out on some growth. Next year, I think what we're going to see is a slower pace of growth in AI investment. It will keep growing, but more slowly, and that will free up some resources for perhaps a little bit more boring, but actually more economically useful areas of the economy in the near term.
Boring can be good sometimes. Paul, thank you very much for joining us, and a big Merry Christmas to you. We won't see you until next year now, so thank you so much for your contributions this year. Paul Donovan with us, Chief Economist, UBS Global Wealth Management. Coming up on the show, Amazon eyes a $20 billion OpenAI investment. We'll discuss. Plus, the streaming wars continue with Warner Brothers reportedly set to push shareholders to reject Paramount's hostile bid. And we'll get a check on the health of the German economy with IFO President Clemens Fuest. That conversation coming up at 9 London time.
Executive Decisions is the new podcast from CNBC where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
United States Trade Representative Jameson Greer has threatened to hit back at European companies over what he described as a course of disciplinary and harassing lawsuits, taxes, fines and directives against US service companies. In a post on X, Greer named Mistral, SAP, Spotify and Siemens, who he said had been able to operate freely in the US for decades. Mistral only was created about 2 years ago, so I'm not sure how it's operated there for decades. He said the US had raised these issues with Europe previously without receiving engagement or an acknowledgement of their concerns. Vibe coding startup Lovable's latest funding round values the firm at $6.6 billion and includes US VC firm Accel. Sources with knowledge of the deal have told CNBC. That's more than triple the valuation that the Swedish AI company achieved after closing its most recent funding round in July. For more on this story, including who's participating in the latest round, you can check out cnbc.com.
Amazon is in talks to invest around $10 billion in OpenAI and use its chips. CNBC has confirmed the deal could value the artificial intelligence company at more than $500 billion. The discussions come after OpenAI completed a restructuring in October and formally outlined the details of its partnership with Microsoft, giving it more freedom to raise capital and partner with companies across the broader AI ecosystem. Well, OpenAI also in the news for hiring the former UK Chancellor of the Exchequer, George Osborne, as its head of OpenAI for Countries, where he will lead the company's Stargate expansion, a $500 billion initiative to build data centers in the US. But I think his initiative is to expand that on a global basis.